Welcome, curious minds, to another deep dive. Today, we're plunging into the pretty surprising landscape of global markets in 2025.
That's right.
It's our mission. To unpack the complex, sometimes really counterintuitive forces shaping the world economy this year, we're distilling insights from, well, quite a stack of expert sources. And this isn't just about the numbers, right? It's about understanding the profound, often unexpected impact of policy uncertainty. So let's start there. What's the big picture looking like for 2025?
Well, what's fascinating really is the consensus. You look at the major institutions, the IMF, World Bank, OECD, and they're all saying the same thing. We're looking at a synchronized global slowdown.
Synchronized slowdown.
Yeah, and they've significantly downgraded earlier forecasts. So it signals a real shift in outlook.
A slowdown? Okay, that's definitely a headline. But what makes this one different? Are the sources plating to something maybe unusual driving it?
That's precisely it. And this is the striking part. The consensus is this isn't your typical cyclical downturn. The critical nugget here, surprisingly, is that it's being called an artificial political creation.
Artificial. Wow.
Meaning it's directly linked to a sudden tariff shock and these other sharp policy shifts. And without these, the analysis suggests global growth would have likely been stable, maybe around 3.2%.
That's a powerful distinction. So not a natural economic cycle, but something policy-driven.
Yeah.
Okay, so thinking about the U.S., it was a huge growth engine in 2024. How's it handling these self-inflicted headwinds you mentioned? Things like new tariffs, businesses maybe front-running imports.
Exactly. The forecasts show the U.S. economy decelerating pretty significantly. I mean, net exports, for instance, they actually subtracted a historic 4.8 percentage points from Q1 U.S. GDP. That's massive. And you contrast that with the Eurozone, which is seeing, well, a fragile kind of tepid recovery. And then China battling its own structural slowdown, compounded by these trade frictions and their ongoing property issues. This regional divergence is absolutely key right now.
And that pivotal event, what the sources are calling Tariff Tuesday, that seemed to really shake things up. Sweeping new U.S. tariffs, 10% globally, 25% on cars, 50% on steel, aluminum, plus specific duties on China, Canada, Mexico. What was the real impact beyond just the cost?
Right. The true damage wasn't just those direct duties. It was the radical uncertainty, the confidence shock it created.
Confidence.
Yeah, it just paralyzes corporate decision-making. When you face that much instability, companies naturally tend to, pause in the near term. They reduce investment, cut spending.
Makes sense.
We saw, over $5 trillion wiped off the S&P 500 in just 3 days after that announcement. That's a pretty clear sign of that confidence shock.
Oof. So if companies are pausing, what does this mean for global commerce itself? It sounds like we're moving away from that hyperglobalization idea.
It really is. We're seeing a definite shift to fragmentation. The sources are highlighting the rise of friendshoring.
Friendshoring, right.
Yeah, where companies move operations not just out of China necessarily, but specifically to countries seen as politically aligned. Think Vietnam, Mexico, India, these connector economies. They're actually benefiting as they try to mitigate that geopolitical risk.
Interesting. So connecting this to financial markets then, does this mean that whole U.S. exceptionalism story, which has been so dominant, is that fading?
It definitely seems to be. That narrative, which drove so much recently, it's distinctly fading. Yeah.
I really see it in the currencies, can't you?
Yeah.
The U.S. dollar, worst first half performance in decades in 2025.
Yeah.
What's driving that sharp drop?
And that's the key question, isn't it? Why is this happening? It seems to be these structural headwinds from U.S. fiscal policy concerns, plus the erratic trade policy. Together, they're actively undermining the dollar's traditional safe haven status.
So who benefits?
Well, this tends to benefit the euro and the Japanese yen, too. And it's actually helping emerging market currencies. It sort of signals these broader concerns about, fiat currency debasement, the idea that maybe traditional money loses value with all this instability.
Right. Okay, shifting gears slightly, what about commodities? Is it a similar kind of split picture there?
Absolutely. It's really a tale of two markets. On one hand, you've got a pretty bearish outlook for industrial metals, for energy. Oil forecasts are hovering around, $66.90 a barrel, mostly because of that global slowdown we talked about.
Okay.
But the powerful contrast is precious metals. Gold, especially, is described as being in a secular bull market. It shattered records, going past $3,000 an ounce.
$3,000.
Yeah, it really reflects gold's role as the kind of ultimate safe haven asset when you have this much policy and geopolitical uncertainty swirling around.
So even with all this turbulence, Are there still bright spots? Any growth engines pushing through?
Interestingly, yes, there are still pockets of massive investment. AI, for one, is still seen as an unstoppable supercycle. It's attracting huge sums. Over $300 billion in infrastructure spending alone this year is projected.
Wow.
And the accelerating energy transition keeps rolling. Clean energy investment is now apparently doubling fossil fuel investment. So these are powerful, durable growth engines kind of counteracting the broader slowdown.
Okay, so let's bring it back to the listener. What does all this mean for your strategy if you're trying to navigate this? It really sounds like the old investment playbook might be, well, outdated.
Precisely. The sources really stress an imperative shift.
Yep.
It's moving from purely seeking efficiency towards building resilience.
Resilience, okay.
And that implies strategically maybe reallocating capital towards non-U.S. assets, thinking about Europe, maybe EM equities and debt. And it also signals a return to needing active management to really navigate this volatility and divergence.
And for businesses listening, what's the takeaway?
For businesses, well, the question you need to ask is about risk. It means embedding geopolitical risk management right at the C-suite level. And it means actively building supply chains that are geographically shorter, simpler, and just more resilient. The landscape has fundamentally changed.
It certainly sounds like it. 2025 is really shaping up as a year of, well, extraordinary uncertainty and divergence.
Yeah.
Very complex, policy-driven picture.
Indeed. And it really underscores the paramount importance of prudence for governments, for institutions, certainly for investors, and maybe highlights the critical need for, multilateral cooperation to try and navigate these choppy waters.
Absolutely. Understanding these trends isn't just academic. It feels crucial for navigating whatever comes next. We hope this deep dive helps you continue your own thinking. Until next time.